Welcome back, everyone. Michael here with Offshore Citizen. Today, we're going to dive into a very interesting subject which can kind of trip a lot of people up. We're going to cover a particular set of tax complexities that a lot of people misunderstand and they miss key slices of it. So stick around till the end. And that is what to worry about from a tax standpoint when you are investing abroad. In other words, what taxes may come to bite you, which taxes may have caused you issues, etc. So stick around. I'm going to cover that for you in depth so you can be very clear on the subject. Before we get started, as usual, if you haven't already, please, we'd really appreciate it if you click the subscribe button, click the notification bell. You'll find out about all our other videos. I try to produce lots of great content for you. If you like this video, then sometime in it, click the thumbs up, the like button. It really helps us with the YouTube algorithm. And if not, please tell us what it is that you didn't like, and tell me I'm wrong, tell me I made a mistake or something like that. Really would appreciate the feedback. If you're interested at all in these topics, which is international tax planning, so how to pay the lowest legal amount of tax possible, asset protection, offshore company formation, offshore bank account, residencies, payment processing, citizenships, etc. Basically doing business around the world internationally. Please reach out to us. We're happy to help you. That's what we do every day. And so please click the link below, clarity.fm/Michael Rosmer. Or check out our websites, offshorecitizen.net, offshorecapitalist.com. Okay, before we get started, you may notice I have this cool shirt, the Solutions Podcast. Why? Well, because of the fact that I recently launched a cool little podcast with a friend. It's available on YouTube. You can check it out, where we discuss, solutions to the world's biggest problems. Kind of a fun project. So anyway, go check it out. Anyway, let's dive in here. How does this work? So imagine that you're in your home country and you want to invest. Let's, for the sake of example, say that you're investing in a business or real estate in some foreign country. Okay, cool. So you're going to take your money, you're going to send it overseas somehow, you're going to invest somehow, you're going to produce some sort of return, hopefully you don't lose the money, and then there's going to be that's going to get paid back to you eventually, right? Now, depending on where you are, and depending on the investment, this could be really good for you, or it could be really bad for you, or it could be really complicated, or it could be really straightforward, all right? And the way to understand this is you need to understand what I call the 3 layers of tax in these situations, okay? So the first one is pretty clearly, let's say that I invested in a business in, Germany, right? So in Germany, we got some business in Munich, great, it's operating. There's going to be some tax that's potentially payable there, right? Fairly understandable, right? Same thing if you had a property, the property is producing rental income, probably going to pay some tax. If the property increases in value and you sell, probably going to pay some tax, okay? That's the first tax. Now, the second tax, which a lot of people don't realize, is there's withholding tax, okay? What is withholding tax? Withholding tax is kind of like the tax between countries. So you have country A, country B in between. Why does this tax exist? This tax exists because normally, let's say that you made money in a company. If it was a local shareholder, you would pay it out as a dividend, say, and the local shareholder would get taxed on that dividend, okay? In this case, again, the value is supposedly added locally, but you're not local, so when it pays it out, they're going to withhold some money. Now, that amount of money could be reducible under a tax treaty to half or less in some cases. Maybe there's none. Some countries don't have any. But it is something that you could have to pay. The third is then when you receive it in your home country, you may have to get taxed yet again, okay? So all 3 of these. Now, it gets a little bit more complicated because of the fact that your home country may be trying to tax the foreign company or the foreign investment even before it comes home, okay? So this is like controlled foreign companies rules. Sometimes, say in the case of the US, there's passive foreign investment company rules. There might be management control rules, might be source income rules, lots of different things like this. So you can get your local country's taxes, and these can be just when you bring the money in, but it could also be as soon as the money is made over here. Then there's the taxes over here when the money is made. Then there's when the money is sent, you also get taxed again. Okay, so 3 layers of tax you need to be aware of. That's, kind of cumbersome. So like, why would anyone want to do this, right? Well, first of all, in a bunch of cases, you will get tax credits in your home country for the tax paid abroad. Okay, this is a possibility. So that's pretty good. Next, sometimes your home country won't tax the income from abroad. Also a good thing. Or will tax it at a lower rate. Also a good thing. The other scenario that can happen is that sometimes it doesn't get taxed in that country. So let's talk about like a really specific example here. Say you're going to buy stock in a company. Okay, so great, I go and I buy stock in this company. Let's say it's a venture capital type investment, or like I'm investing in a startup, right? The startup becomes worth, a bunch more, makes a bunch of money, it gets bought out, okay? When it gets bought out, the sale of those shares very often is not taxable over here. It's also very often not subject to withholding tax, okay? It's capital gain. And then the question is, does it get taxed at your home country? It may or may not, right? Depends on that scenario. But often it's taxed again at a lower rate, right? So you can end up potentially paying no tax on that investment. So imagine that you were, let's say we're talking about like somebody in, I don't know, some place with a territorial tax system, like say Hong Kong, right? So you're in Hong Kong, it's actually in your best interest to invest abroad as opposed to investing domestically, because potentially if you choose your jurisdiction well, you can pay less tax. Now, of course, if you're in the wrong jurisdiction, this could also mean double tax, it could also mean extra tax, it can be pretty bad. So why do I tell you this? Well, first of all, so that you don't get bitten and so you can plan it properly. And if you need help, please let us know. You can reach out, book a call, clarity.fm/Michael Rosmer, link below, and I will help you through it. If that's not the case though, what you may want to look at is you may want to say, okay, great, I'm gonna be doing some investing, where should I invest? And if you're not considering the tax consequences as part of your investment strategy, I think you're going kind of wrong. Because imagine that you're going to pay 30% tax through that foreign place. Well, if you made, let's just say $100,000 and you have to pay 30% tax, now you're down to $70,000 versus somewhere else, maybe you would have made $80,000, but you wouldn't have gotten taxed. Well, you're in a better situation, right? Let's start talking as well about how there's going to be some other consequences. Imagine that you want to decide how to structure. So let's talk about, say you're doing a real estate investment, okay? Say you're a foreigner who wants to invest in real estate in Canada. If you buy a property in Canada, the rental income will be taxable in Canada, okay? But if you can lend money via, let's say you did some sort of a mortgage and it had some sort of a balloon interest payment associated with it, the interest is very likely not taxable in Canada, okay? So, you could have a fairly high interest rate that you're charging potentially, right? It could eat up all the rental income. Well, it's the same consequences in many regards, right? But you ended up decreasing your tax. So how you structure and where you structure can make a big difference in your ultimate rate of return. So that's why I think it's really important for you. And if you're thinking about doing some international investing, please reach out to us. We're happy to help you and figure out like where is the best place as well as how best to structure it. Because especially as you get larger and larger investments, that can add up to quite a bit. So anyway, hope you liked the video. If you did, please give it a like. Click the subscribe button, click the notification bell, check out some of our other videos. If you're interested in these sorts of things, if you want help, book a call with me, clarity.fm/Michael Rosmer, or check out our websites, offshorecitizen.net, offshorecapitalist.com. And also check out the Solutions Podcast. It's on YouTube. So anyway, see you guys on the next video.